This is the 2006 Amazon letter to shareholders. Amazon's 1997 shareholder letter lays out a disciplined philosophy for growing new businesses from small beginnings. Bezos explains how the company evaluates opportunities for scale, returns, and customer differentiation. This letter offers early insight into Amazon's strategic seeds, FBA, AWS, and international expansion.
To our shareholders, at Amazon's current scale, planting seeds that will grow into meaningful new businesses takes some discipline, a bit of patience, and a nurturing culture. Our established businesses are well-rooted young trees. They are growing, enjoy high returns on capital, and operate in very large market segments. These characteristics set a high bar for any new business we would start.
Amazon is framing new ventures as disciplined experiments rather than opportunistic expansions. The well-rooted young trees analogy underscores that existing operations already deliver strong returns, so any new business must meet high expectations. This demonstrates early capital allocation rigor, ensuring shareholders' funds are only deployed to initiatives with clear potential for scale and profitability.
Before we invest our shareholders' money in a new business, we must convince ourselves that the new opportunity can generate the returns on capital our investors expected when they invested in Amazon. And we must convince ourselves that the new business can grow to a scale where it can be significant in the context of our overall company.
Here, Bezos explicitly ties new ventures to ROIC standards. This shows a disciplined capital-first mindset. Small experiments are only valid if they could eventually influence the company's broader financial performance. The emphasis on significance relative to the company's size foreshadows how Amazon later measures success in absolute and relative terms, not just revenue growth.
Furthermore, we must believe that the opportunity is currently underserved and that we have the capabilities needed to bring strong customer-facing differentiation to the marketplace. Without that, it's unlikely we get to scale in that new business. I often get asked, when are you going to open physical stores? That's an expansion opportunity we've resisted. It fails all but one of the tests outlined above.
Bezos is distinguishing between large but saturated markets and those where Amazon can uniquely differentiate. The physical store example illustrates disciplined avoidance of low ROI opportunities, despite apparent excitement. It signals that Amazon's growth isn't about chasing trends. It's about exploiting underserved areas where their operational capabilities create competitive advantage.
The potential size of a network of physical stores is exciting. However, we don't know how to do it with low capital and high returns. Physical world retailing is a cagey and ancient business that's already well served. And we don't have any ideas for how to build a physical world store experience that's meaningfully differentiated for customers.
This reinforces Amazon's analytical rigor. Size alone isn't enough. The venture must meet three tests: low capital intensity, high returns, and differentiation. Avoiding physical stores early demonstrates a disciplined focus on scalability and innovation within their core competencies, a mindset that later enables success with e-commerce first movers and cloud infrastructure.
When you do see us enter new businesses, it's because we believe the above tests have been passed. Our acquisition of JOYO.com is a first step in serving the most populous country in the world. E-commerce in China is still in its early days, and we believe it's an excellent business opportunity. Shoes, apparel, groceries. These are big segments where we have the right skills to invent and grow large-scale, high-return businesses that genuinely improve customer experience.
Amazon's move into China signals a methodical approach to international expansion. They enter markets with high potential, yet low incumbent differentiation. By identifying large, underserved categories like shoes, apparel, and groceries, Bezos demonstrates a repeatable framework. Pick markets where Amazon's logistics and customer-centric philosophy create measurable advantage.
Fulfillment by Amazon is a set of web services APIs that turns our 12 million square foot fulfillment center network into a gigantic and sophisticated computer peripheral. Pay us 45 cents per month per cubic foot of fulfillment center space, and you can store your products in our network. You make web services calls to alert us to expect inventory to arrive, to tell us to pick and pack one or more items, and to tell us where to ship those items. You never have to talk to us. It's differentiated, can be large, and passes our returns bar.
FBA illustrates monetization of core infrastructure. Amazon leverages fulfillment as a service, creating a scalable revenue stream beyond its own sales. This early example of platform thinking, turning operational capabilities into an API-accessible service, foreshadows the modern AWS business model. It also demonstrates early recognition of network effects and capital efficiency.
Amazon Web Services is another example. With us, we're building a new business focused on a new customer set, software developers. We currently offer 10 different web services and have built a community of over 240,000 registered developers. We're targeting broad needs universally faced by developers, such as storage and compute capacity areas in which developers have asked for help, and in which we have deep expertise from scaling Amazon.com over the last 12 years. We are well positioned to do it. It's highly differentiated, and it can be a significant, financially attractive business over time.
AWS is an early blueprint for platform-scale innovation. Bezos emphasizes solving real customer pain points, developers' storage and compute needs, while leveraging Amazon's operational knowledge. This illustrates disciplined identification of underserved markets combined with core competency alignment, an approach that would redefine enterprise IT and cloud computing profitability.
In some large companies, it might be difficult to grow new businesses from tiny seeds because of the patience and nurturing required. In my view, Amazon's culture is unusually supportive of small businesses with big potential, and I believe that's a source of competitive advantage.
Here, Bezos explicitly ties culture to strategy. Amazon intentionally builds an environment where small teams can innovate without being crushed by bureaucracy. This early acknowledgement of organizational behavior as a competitive lever demonstrates foresight. Culture itself is a scalable asset supporting sustained innovation across multiple verticals.
Like any company, we have a corporate culture formed not only by our intentions but also as a result of our history. For Amazon, that history is fairly fresh and, fortunately, it includes several examples of tiny seeds growing into big trees. We have many people at our company who have watched multiple $10 million seeds turn into billion-dollar businesses. That first-hand experience and the culture that has grown up around those successes is, in my opinion, a big part of why we can start businesses from scratch. The culture demands that these new businesses be high potential and that they be innovative and differentiated, but it does not demand that they be large on the day that they are born.
Amazon institutionalizes learning from success. Employees internalize the journey from $10 seeds to billion-dollar businesses, creating a self-reinforcing loop of entrepreneurship. This signals an intentional design. Culture supports high-potential experimentation without requiring instant scale, reducing risk while preserving upside.
I remember how excited we were in 1996 as we crossed $10 million in book sales. It wasn't hard to be excited we had grown to $10 million from zero. Today, when a new business inside Amazon grows to $10 million, the overall company is growing from $10 billion to $10.01 billion. It would be easy for the senior executives who run our established billion-dollar businesses to scoff, but they don't. They watch the growth rates of the emerging businesses and send emails of congratulations. That's pretty cool, and we're proud it's a part of our culture.
This anecdote shows senior leadership actively supporting micro-scale growth. Encouraging small successes in a massive organization is critical. It validates experimentation, motivates teams, and prevents early-stage ventures from being stifled by large company inertia. Bezos highlights culture as a tangible asset driving long-term value creation.
In our experience, if a new business enjoys runaway success, it can only begin to be meaningful to the overall company economics in something like 3 to 7 years. We've seen those time frames with our international businesses, our earlier non-media businesses, and our third-party seller businesses. Today, international is 45% of sales, non-media is 34% of sales, and our third-party seller businesses account for 28% of our units sold. We will be happy indeed if some of the new seeds we're planting enjoy similar successes.
Bezos sets realistic expectations on time horizons. Even high-potential ventures require years to materially impact overall economics. This demonstrates patience and long-term orientation, crucial traits for investors evaluating Amazon's capital allocation. The numbers show early diversification success and reinforce credibility in future growth initiatives.
We've come a distance since we celebrated our first $10 million in sales. As we continue to grow, we'll work to maintain a culture that embraces new businesses. We will do so in a disciplined way, with an eye on returns, potential size, and the ability to create differentiation that customers care about. We won't always choose right, and we won't always succeed. But we will be choosy, and we will work hard and patiently.
Amazon's philosophy balances ambition with discipline. The focus on returns, differentiation, and patience underscores capital efficiency, while candid acknowledgement of failure risk increases investor trust. This approach legitimizes experimentation, showing that even early-stage ventures are rigorously evaluated against meaningful metrics. Amazon's 1997 shareholder letter highlights a disciplined, repeatable framework for identifying, funding, and scaling new ventures. Success requires high potential, differentiation, and alignment with Amazon's core capabilities. Early moves like FBA, AWS, and China expansion illustrate this methodology in action. Culture is deliberately structured to support small experiments without sacrificing capital efficiency. Bezos emphasizes patience, multi-year horizons, and realistic expectations for meaningful impact. Investors gain confidence knowing that only ventures meeting clear ROIC thresholds are pursued. The letter foreshadows Amazon's ability to convert operational scale into new revenue streams. Even early on, Bezos is blending strategic rigor with cultural support, a combination that has become a hallmark of Amazon's growth strategy. This letter offers both a blueprint and a lens for evaluating Amazon's long-term value creation.